Yeah, I think we can go ahead and get started, Allie.
Okay.
Yeah.
Good. I almost said good morning. Sorry, it's been a busy week. Good evening, everybody. I am Allie Surbaugh, the marketing director for Sterling Financial Management. We have Sterling clients here and Woodsboro Financial Service clients with us, and we are going to talk about Social Security tonight. So we have Dave Nieder, who is our president and founder and private wealth manager. He's been doing this for over 25 years and has a lot of good information to share with you all. Please let us know at any point if you have any questions. If you think of a question tomorrow, please let us know. You can reach back out to us and we will send out the slides tomorrow as well. So Dave, go ahead and take it away.
Well, thank you. Thank you guys for joining us tonight via Zoom. And so if there's one good thing maybe out of COVID is we've learned how to do stuff remotely. So we can sit in our easy chairs, maybe have some popcorn and learn about Social Security. So we've got a lot of good information we're going to share with you. We've really spent the last couple of years here just really learning Social Security, getting a deep dive into it, spending some time to become I don't know if I want to call myself an expert in the field, but definitely fairly knowledgeable with that. And we've got some really good resources behind us. Some folks that have spent 30 years in the Social Security department. So if we have questions we can't answer tonight, we can definitely get some answers for that, for your questions. So with that, we're going to dive right into Social Security. So as Allie had mentioned, there's kind of two sides to our business. So we have Sterling Financial Management, and as well as we help Woodsboro Financial Services. So we are the financial advisors for Woodsboro Bank in their Woodsboro Financial Services department. And so let's go ahead and get started here. And I'm showing one person in the waiting room, but I think everybody came in there. So, all right. So I think I went back past our, yeah, so here we go. We've got, well, tomorrow you'll get a survey. So Allie does a fabulous job on keeping everything moving smoothly. So if you don't mind taking that survey. Also, you can find more information on the Woodsboro and Sterling website. We'd appreciate it if you'd go out, like us on Facebook, and you can find more information also on LinkedIn. There's our disclosure that I was looking for. So, you know, as knowledgeable as we are, you know, we would refer you to the Social Security administrative offices for that. You know, highly recommend making an appointment with them as well. For getting exact information on what you're going to get, you know, in retirement. These are some of the things. So we've really ramped up our educational opportunities. So we're going to have healthcare, kind of talking about long-term care, a Medicare, and then an estate planning. I think we might even do this one more time later on in the year. So where did Social Security come from? So it's first signed into law from Lyndon B. Johnson.
Dave, your slides aren't showing.
You know what? Thank you. Because I didn't share my screen.
That helps.
Yeah. About that.
Very good. There we go. We can see it now. Thank you.
Okay. Thanks for keeping me on track there, Kelly. All right. So 1935, Lyndon B. Johnson. So initially, it was only for those that were working. 1939, it was actually passed for spouses, survivors, and for minor children. So it was the first time a spousal benefit came out. And so spouses were able to get 50%. And of course, you know, back in the 30s, probably most primarily male dominated workforce which we know, of course, is now not the case, but early 30s, yes. And so it was 39 added a spousal benefit for the wives and for children. And so that same 50% is still eligible for today as well. So Social Security is one of those, we use the term kind of pension maybe. So it is one of those sources of in retirement that you can't outlive. And of course, a very important decision in coordinating this with your retirement. And you could receive as much as up to $1 million over a 30-year period. So the maximum benefit right now is close to $3,600 a month. So as you can imagine, $3,600 almost twice as much as two. So it could be as much as up to $2 million. So a super, super important decision to help coordinate that with other things that you have going on. So this little slide here just kind of shows you the power of compounding, even as at a lower rate as 2%. So a $2,000 a month benefit, if you were to collect that now in 30 years, could be as much as up to $3,600 a month. Now that's only a 2% cost of living adjustment. We'll kind of see here, we may be in a patch of maybe a higher round of inflation kind of a cycle. Of course, last year, the Social Security adjustment was I think like 8.3. And this year closer, the kind of number that we're hearing is maybe as much as up to 3.6%. So you do get an increase in your Social Security every year, depending on that cost of living adjustment that does come out and is announced, every year. So a couple of definitions to kind of keep in mind. One of them is the term we would use is full retirement age. So depending on the year in which you were born, so really if you were born 1958, anybody really 1957 and before has already kind of reached their full retirement age. But 1958, 59, you guys are kind of getting close. And then anybody born after 1960, the full retirement age is age 67. So of course, we're in this battle here for the debt ceiling, and we're talking about, when is Social Security maybe on shaky footing? When are we going to run out of Social Security? And so I wouldn't be a bit surprised here in the next couple of years if Congress doesn't tackle this. And, maybe those age 55 and younger may see a retirement age, maybe 69, maybe 70. So I wouldn't be a bit surprised we don't see that full retirement age going up here in the next couple of years. So full retirement age is an important kind of a number to know. Your primary insurance amount. So what is that? That is really the age. So if your full retirement age is age 67, that's technically what your benefit base and all the other calculations. So if there's any spousal calculation that we're going to do, or any reductions or any benefit increases, it's based off of that primary insurance amount. So kind of what you're looking at here is a little snippet of what you would see if you went to the SSA.gov, logged in there, and pulled up a statement from your Social Security. So I would highly recommend that. Number one, you're creating a profile for yourself. So heaven forbid somebody goes in and tries to hack the system, you'd get some notification of that, and kind of taken over your own profile. So I would definitely highly recommend you do that. Also, it is going to give you a projection of what you would get, at your full retirement age. Just kind of a little note here, and it may be covered later, but so your PIA is based on your 35 highest earning years. So let's say you started in the workforce and then maybe sat out for a couple of years, or maybe raised some kids or something like that, and then step back into the workforce. They're going to look at your 35 highest years. So one of the things that kind of comes into play is if in those 35 highest years you have, like, let's say maybe you didn't work at all, replacing those with some earnings has a dramatic impact. But let's say you've been working a long time, had a fairly high wage. We've noticed that even some people maybe quit working at 57, 58, and their benefit really is not affected because they've packed their 35 earning years with a pretty high earnings. So PIA. So that's kind of another key. All right. So what happens if you apply before your full retirement age? So this little slide here, and Allie will send the slides out to you tomorrow, so you'll have these. But so there is a penalty for collecting before your full retirement age. So a lot of the stuff you'll see on Social Security lists things in full years, like 63, 62, but really you can apply in any month past your eligibility date. So everybody's eligible as of age 62. But if you apply early, there is going to be a penalty for applying early. We're showing here, let me kind of forward to this next slide so you can kind of see the difference. So the person that is applying, if their full retirement age is 66, they have a 4-year penalty period, where if somebody is age 67, they've got a 5-year penalty period, right, for applying early. So you can see the person that is applying, that's only 4 years, their penalty is not as great. So one of the things I'm sure we're going to see happen is that, as that full retirement age goes up, the government normally leaves the eligibility date at 62. So if all of a sudden retirement age is 69 and that person retires at 62, that's a 7-year early. And so the penalty just keeps getting bigger and bigger. So in this case, a 25% penalty for retiring early. If you're age 67, which is my category, I'd have a 30% penalty and a 30% reduction in my Social Security benefit there. So just keep that in mind, an important thing. So, if you retire early, one of the things to realize is that is a permanent reduction in your benefit. So it other than your cost of living increase, it'll stay at that lower level. So even if you get to your full retirement age, even though you collected early, again, it has no impact. You never kind of get back that reduction that you got hit with in the beginning. So the other thing is that there's some people are like, well, I want to double dip, so let me work and then I'll collect my Social Security. And unfortunately, the penalty is pretty stiff. So if you are collecting before your full retirement age, there's a $1 in benefit reduction for every 2 you earn. So essentially, it's a 50% reduction for every dollar that you make. So let's say I make $22,000. So I've made $1,000 more than the limit. My Social Security would be reduced by $500. So $1,000 over the limit, and I'm losing $500 in benefit. So as you can see, it's a pretty stiff penalty there for collecting early. So in a lot of cases, unless you're getting paid cash under the table or something like that, you probably, you really got to watch those thresholds. Now that level is also adjusted for inflation, but pretty low level there if you're going to try and collect and work at the same time. So there may be some reductions in spousal strategies, and your surviving spouse's benefit will be lower. So we'll go through one of an example of that later on, but you collecting may potentially affect your spouse's benefit if they're going to be relying on your benefit for some of their benefits. So, all right. So we talked about collecting early. Well, how about if we delay? Well, there is an 8%. There is an 8% credit for every year that you wait to collect that benefit. And again, the earlier we saw there that the earlier person, age 66, gets a 32% increase, where if you're 67, you'd only get a 24% increase in that benefit. And so weighting definitely has a dramatic impact. And we're going to see also, maybe if I go back here and look at that benefit. So, if you start compounding, one of the things that can make a dramatic difference is, we talked about our benefit growing every year with the cost of living adjustment. So if I start compounding my benefit at a much higher level, it's going to grow just that much, just that much faster. And it makes a dramatic impact the longer you live. So definitely longevity, has an impact on what you get. So also looking at the cumulative benefits that you would collect. So starting at age 70, you can see that you would collect about 800,000 if you lived to age 85 versus, close to maybe 600. So a $200,000 difference in benefits there. So, as we said, starting early stays lower. We also kind of mentioned cost of living has a dramatic impact, and just keeps getting bigger and bigger. And we'll see an example of kind of how that plays out a little bit, later on. And as we also mentioned, could have an impact on the survivor. So let's say we have a husband and wife, and let's say the wife's benefit is dramatically bigger. If the wife was to pass away, the husband is able to collect that higher benefit if she passes. So spouse, let's say spouse takes her benefit at age 62, again, that dramatically impacts the other party that may have a higher benefit somewhere along the way. So definitely a good idea to figure out who's got the better benefit. So, as we'd mentioned, a spouse can collect off of the other worker. And so we'll look at a definition. We'll look at some kind of examples of how that plays out. So a couple of key things to realize is entitled as opposed to eligible. So entitled means that you're just, you can claim the benefit, but eligible is actually when you're able to claim that benefit. So if your spouse is not 62 yet or has not filed the benefit, you may be entitled to it, but we've got to watch that eligibility. So here's an example of kind of how that we can see this kind of playing out here. So we've got our good example here of Jack and Jill. They're married, both full retirement age. Jack has paid into Social Security. His PIA is $2,400. Jill has been a stay-at-home and has never worked. So Jack has to file for his Social Security benefits, and in order for Jill to be able to file for her spousal benefit. So if there is no work history for Jill, she would get 50% of whatever Jack would be eligible for, or $1,200. And now sometimes it can get a little bit more complicated than that, but we'll look at some examples here. So if a spouse applies before their full retirement age, then that spousal benefit would be reduced. So in our case, if Jack was to collect his benefit at age 62, Jill would only be eligible for 35% of whatever Jack would get. And again, that reduction is even worse. So, the first little paragraph there, first box is if for somebody 66, the second kind of box there is for those 67. So, the reduction just compounds itself for that individual. All right, so we talked about women and men in the workforce, and of course, over time here it's about equally split between that. And so a lot of folks now are qualifying for benefits on their own record. So we can kind of see that playing out here in that women now qualify for their own record about 75% of the time. So having to rely solely on the men's or males benefit is becoming less and less common. But so in order for spousal benefits to kick in, as we said, the primary must have filed and the spouse must be at least age 62 for a reduced benefit, or if they waited clear up to the full retirement age, then they would be eligible for that 50% benefit. So, the spousal benefit is based on the worker's PIA and not the actual benefit. So that's kind of how we'd said that's what the calculation is based on. The other thing is that there's no delayed credit. So if the spouse waits until past their age 67 or 66, then there's really no increase in their benefit. So pretty much what, collecting the spousal benefit at age 67 is maximizing, is going to maximize that benefit. So just one little caveat to that is that you are required to be married for at least a year in order to be eligible for those spousal benefits. And so we'll look at an example of a divorce situation that's a little bit different, but so we'll take a look at divorce situations here in just a little bit. But so what if a spouse is entitled to Social Security on their own work record? So the spouse is going to get really the higher of either their benefit independently or their personal benefit plus maybe a little spousal, I'll use the term kind of kicker or add-on or something like that. So here's kind of a little example of how that would play out. So we've got Jack and Jill again. Jack's full retirement age, Jill is 62. So right there, we can kind of key in that Jill is probably going to have a reduction, right? Because she's going to be collecting at age 62. So Jack's PIA is 2,400. Jill's PIA is 800. So, we may think, well, half of 2,400 is 1,200. So Jill should really get another 400, but we'll see how that plays out here. So first of all, Jill, because she's collecting at 62 and not her full retirement age, gets a reduction. So she takes the 70% hit on the 800. So that's 560. And then $260 in additional benefit for the spousal. Again, she only gets 34% of Jack's PIA. And so, her total benefit there would be 820 instead of the 1,200 that she, may have been eligible for. Okay, so we'll, some of the strategies that you may want to consider is, there's kind of only a couple ones here, but, if both spouses claim early, you're able to get some income now. But as we'll see, that means less, maybe less in comparison than if they had waited. Both spouses can claim later. So if we're both eligible, maybe we want to wait and get that delayed credit working for us. Or in some cases, really, and this one actually probably works out the best, is if one has a really high benefit compared to another, maybe one claims early, the lower earning, and then the other spouse would claim later. And those actually work out fairly well. We'll show you some examples of that. This is the company that we use as the kind of the experts behind the scene, but they also help supply our software. And so we're able to create a report for you that would help you to kind of think through some of those scenarios. So if you can get your PIAs and get us those assumptions, we can help you to kind of think through and do some really good planning on when to collect and how that would play out. So we've got an example here of Joe and Jane, same age, PIAs 2,400 and 800. Usually we're going to assume that the male passes away first. So life expectancy maybe of age 85 and the female maybe age 95. Females just tend to live a little bit longer, but your situation could be different. So we can run scenarios if you think maybe heaven forbid, your family doesn't have a history of long life expectancy. Maybe we make that a little bit shorter or what have you. But so looking at a couple of different scenarios here, if they both would claim at age 62. So of course, Joe takes a hit, Jane takes a hit, and they're only going to collect 70% of their benefit. And, you can see those amounts there of what they would collect. How about if they both collect later? Of course, Jane now gets the benefit of half of Joe's, so she gets her 1,200. And, for her collecting that, at age 70, so we're both going to assume they collect that at age 70. And which really, I think, a little bit of a misnomer, right? Because we said that there's no increase in that spousal benefit, but so maybe Jane could have collected that a little bit early. How about the other one then? Jane collects early. She's the lower earning spouse. And then Joe claims later. So these little graphs I don't find necessarily helpful, but so let's go to kind of the cumulative benefits here in real dollar terms. So both claim early, they would both collect about 934,000. But if you look there at both claiming later, they would collect 1.1 million. But look at that, how close that Jane claims early and Joe claims later. In fact, that's actually a little bit more benefits. So in some cases, maybe one spouse collecting early isn't necessarily a bad thing. And the cumulative benefit comparison there. So that's kind of the output that we can look at for you, and you can kind of see that. And this is an important, we've mentioned in the beginning. So here's an example kind of playing out where what that compounding benefit can really grow to later on. So we had Joe passing away at age 85. The first year that Joe passes and Jane begins to collect Joe's benefit, she would get $23,000 a year if Joe and her had claimed early. Well, what if Joe had waited those 3 extra years? Her first year in retirement, she would be claiming $35,000. So $12,000 more per year she would get in those benefits. So just kind of shows you the power of that compounding, what that can have, and just maybe some delayed gratification there, if you will, on your benefit. Because how many people do we know that are just living on Social Security? The longer time goes, it seems like they just struggle more and more and more to make ends meet. And you can imagine how much easier maybe life would be with an extra 12, 13,000 in benefits. So you can really see kind of a big difference there with those benefits. So we can run those customized scenarios. Again, if you can get that PIA, we'd be happy to sit with you and help you kind of think through those different scenarios. And I'd also highly recommend you sit down with the Social Security Administration. I think they're seeing people in person again. I think that is open. There used to be an office right out near the mall in Hagerstown. I know Martinsburg, I think, has an office, and Chambersburg as well has an office. So, and I know kind of their appointment times are fairly fairly long. So if you want an appointment, you about got to go 3 or 4 months out. So it's important to get that phone call and get in there and see them. But their job is really to help you to claim your benefits at the earliest, and not necessarily maybe give you a recommendation on what they would do. Okay, so let's jump into kind of some survivor benefits here. So what are the benefits that are there and eligible for a survivor? So a couple of things to realize is that what may impact that benefit is when the deceased spouse originally claimed his or her benefit. So again, if that if a spouse is gonna live off of the deceased, when they took it's going to have that impact of, so if they took it early, took a penalty, that also would pass to the widow. So when the widower or widow actually claims the benefit also has an impact as well. So even if in our example, let's say we took it at full retirement age, but widower takes it maybe at age 62, that's going to have a reduction. And so we'll look at some different examples here. So Joe and Jane, they're married. Joe's PIA 2,400. Joe dies at age 70. If he had claimed his benefit at age 70, Jane's original survivor benefit would be based on that higher amount, or the 2,900, right? So that delayed credit is going to help out Jane. Now, let's say he had claimed his benefit at 62. Jane's original survivor benefit would be based on 82.5% of Joe's PIA, or 1980. So again, there's that reduction. So I wouldn't try and memorize all of those, different percentages and try and calculate that yourself. I would just kind of, again, just get some of the general concepts down that, there is going to be a penalty for collecting early, because some of that penalty depends on what your full retirement age is. If it's 66 and 8 months, 67. So some of those percentages are going to change a little bit, but so again, so here's kind of our tabular things that if looking at, if Joe had claimed at age 62, you can see that reduction. If so, a survivor, or excuse me, a widower. So technically, you are eligible to claim that benefit at age 60. So, but as we're seeing from from these examples, that maybe you don't want to collect at age 60. Why? Because you can see the penalty that you're going to take for collecting that early, as opposed to maybe waiting until full retirement age. So maybe you want to wait and collect that benefit later on. So in a lot of cases, we've looked at and recommended to our clients, widows, widowers, to possibly not collect that benefit. A lot of cases, it means that the deceased had maybe a pretty high benefit, and that's the one they're going to want to collect on. So in some cases, the widower may want to collect on their own record starting at age 62, and then turn on that spousal benefit or the survivor benefit later on. Okay, a couple of key points. So, if your Social Security stops at death. So if Joe had been collecting, his benefit would stop. Then the surviving spouse is entitled to the survivor benefit, and that would be equal to that deceased spouse benefit. So in some cases, if let's say you're divorced and you're eligible to collect maybe on an ex, and that person passes and you're aware of a passing, you may be eligible for a higher benefit. Or, heaven forbid, if your spouse passes, if their benefit is higher, you would step into that, that higher benefit. So a couple of different caveats, right? Depending on when and when Jane would collect it in our example. And of course, you can't collect both benefits at once. So Joe passes, Jane can't collect hers and collect Joe's. So, she's going to have to make a decision on which one that she would collect on. So, and if the widower's benefit is higher, then they would keep their own benefit. So, couple of quirks there on the survivor benefit. So, some planning strategies, as we would probably most likely recommend, but higher earning spouse delays their own benefit. as long as they can. Surviving spouse files for the survivor benefit at full retirement age or later. They can file for their own benefit at age 62. And all right, I got about 10 minutes of battery life left. I didn't realize my laptop was that low. I might have to run and go grab my battery here. We've got about 8 more slides to run through. Okay, couples. So must plan for the loss of one Social Security benefit. So if Jane switches to her survivor benefit, as we said, her own benefit's going to stop. If Jane retains her own retirement benefit because it's higher than Joe's benefit's going to stop. So basically collecting off of one person. So here's some divorced spouse benefits. So essentially it's going to be the same as a spousal benefit. So we really aren't necessarily doing the calculations any different. It's just that if you are divorced, you're still able to collect on an ex-spouse. And but there are some rules surrounding that. So your marriage must have lasted 10 years or more. So that's kind of a key. I mean, if you don't mind doing it, you can get married and divorced as many times as you like, and that just gives you the eligibility to collect on more benefits. So maybe the last person you find is the best one, and he's got the most highest earning. She's got the most highest earning, but so I think Johnny Carson is kind of the poster child for that. He had 3 exes kind of collecting off of his. An important thing to realize too is that you collecting on your ex really has no impact on their benefit whatsoever. So we've had a lot of questions from clients about that. Either in one direction, I don't want that dirty dirtbag to either number one, collect on me or have an impact on me, but really it has no impact. So, and when you go to collect, really the ex doesn't even have to know that you're collecting on that. So you're able to do that really without having to notify anyone. So the other thing is that the divorced spouse has to remain unmarried in order for it to be able to collect on that. And as long as the divorce wasn't more than 2 years ago, then the ex doesn't even need to have filed. So, we
Just bear with us, folks, while Dave gets plugged back in. We apologize. Take a brief intermission if we can. Also, there is a chat feature on this. If you guys want to send in like some questions that we can answer at the end, if you're thinking of, just go ahead and send them in on the chat feature, and we'll talk about it at the end. But you need to unmute, Dave.
all right,
There we
we're back. Sorry about
All
that.
right,
Technical
yay!
difficulties.
But you need to share your screen again.
What's that?
You need to share your screen again.
Okay.
And I think chat is disabled. I'm not sure though.
Oh, it
may
was.
be disabled, but
It was just there. Hold on.
yeah.
No, well, there it is. It's back.
Okay. Sorry about that,
Okay.
guys. Didn't realize my battery was that low.
Thanks, Bruce, for coming to the rescue. We appreciate it.
Yeah, no problem.
All right, so we're talking about divorced spouse. All right, so I think we covered everything on that slide. And we kind of already covered this. So more than one ex can collect off of the record. We already talked about how benefits don't affect the other person. And you just need to kind of show your divorce decree and And if you do get remarried, then those spousal benefits would stop. You would then be either collecting on your own benefit or your current spouse. So rules for divorce, but widowed spouses. So the surviving former spouse. So you have to be age 60 or older. Same 10 years for the marriage requirement. But if the former spouse remarries at 60 or older, they may still be eligible to collect the survivor benefits from their deceased ex-spouse. So, we have had some clients who have waited to get remarried past age 60, so it doesn't impact, those benefits. So just something that you would need to kind of decide for yourself. And again, the former spouse not affected by the benefits that they would be entitled to. Okay, so everybody's favorite topic, taxes. So we're gonna hit that here real quick. So we get a lot of questions about, like what's my retirement income possibilities? And so we've had some folks a lot of times will say, don't I get a benefit for being retired? Like I shouldn't have to pay taxes when I retire. But really, your calculation of taxes in retirement is the same as pre-retirement. You do get a little bit of an extra deduction 65 and older, but essentially you have the same standard deduction that you would have before you retire. So there's no difference in the way we calculate your income, but there is one caveat to that with this Social Security benefits. And so let me kind of describe that for you. So there's a key term that's called provisional income. So provisional income. So essentially what we're doing is we're going to do a calculation that tells us whether none of my Social Security is taxable or would be counted as taxable income, or whether 50% of my Social Security would be considered taxable income, or 85%. So, there are some cases where in retirement, your taxable income and the amount of tax you pay could go down dramatically, but a lot depends on what your income actually is. And so that's this definition of provisional income. So here's how we calculate provisional income and how we know how much of your Social Security may end up being taxable. So the first thing we do is we take the amount of Social Security that you're collecting and we would cut it in half. So let me just give you an example. Let's say I'm collecting $20,000 a year in Social Security. Half of that 20,000 is 10,000. So let's say, so let's just use that as kind of our base case there. So let's say I'm not going to collect any other income in retirement. So let's say I don't have any interest income. I'm not taking any money from my IRAs. I have no municipal bond interest. I have no pension. So if purely that is the only income that I have, half of my Social Security benefit, no other income. So if I'm a single individual, then none of my Social Security would be counted as taxable income. So if I have no taxable income, that means I pay no taxes. So now let's complicate this a little bit more. So let's say I've got $20,000 of my Social Security. Let's say I pull $5,000 from my IRA. And then let's say maybe I have $5,000 in interest income. So same calculation, I made $20,000 in Social Security. I've got 5 in IRA, 5 in interest. So half of my 20 is 10. And then I've got 10 extra thousand in taxable income. Again, $20,000 is less than the 25. So none of that Social Security would be counted as taxable income. And so my exemption as a single individual is, I think it's around 14,000. I think this year is what that is. So I've got a deduction, a standard deduction that is more than my income again. So I've got $30,000 of revenue, of cash flow, 20 from my Social Security, 5 from IRA, 5 from interest. So I've got $30,000 of cash flow and I may pay no taxes at all. So now let's let's go through that calculation again. So, but now let's say I've got 20 in Social Security and let's say I'm making $20,000 in other monies. So again, half my Social Security is 10, 20,000 from other sources. I now made $30,000. So now that half of my Social Security or that $10,000 becomes taxable income. So now the full $30,000 is, or excuse me, we mentioned 20 in a withdrawal, I think 10 from Social Security. So so that $30,000 is going to be counted as taxable income. So again, my standard deduction, let's say 14,000. So 14 minus the 30, I'm going to pay $16,000. So my tax would be on $16,000 of income. So that's essentially, you do a two-step calculation. One is how much of my Social Security do I have to bring in as taxable income? Is it 0? Is it 50%? Or is it 85%? And I'm kind of saying that as if it's a cliff, meaning that, $25,001, it does, you're right, it does bring some of those Social Security taxable, but it's not a cliff in that you immediately bring all 50% in. It is a slow kind of a thing. So between 25 and 34, the amount of your Social Security just gets taxed more and more and more. You have to bring in more and more and more of that Social Security. So I know it's kind of maybe a complicated thing, but just realize that, it's half of your Social Security and then all other income. And then you go to these tables and it will tell you how much of your Social Security that you have to pay tax on. So, it's one of those things where from a tax perspective, of course, we all are not necessarily from a tax perspective, but most of us want to have more income in retirement rather than less, right? We all want to have more to spend. But in some cases, taking out that extra $3,000 or $4,000 may have, a little bit more of a dramatic impact on the amount of taxes that you may end up paying. So, because again, going from 0 to 50 is a big jump, 50 to 85% is a pretty big jump on how much of your Social Security kind of comes back into the equation as being taxable. So how do we minimize taxes on Social Security benefits? Well, one is don't make very much in retirement, which most of us don't want to do. But there may be some other things that, we may be able to kind of work on. Maybe reduce expenses so you may not need as much to draw as much. Maybe a little simpler lifestyle. One of the big things that we've kind of been looking at with clients here in the last couple of years is trying to minimize those RMDs as much as possible. So that's required minimum distributions. So a lot of folks, we're saving in our 401k and our IRAs. Well, as those things get bigger, the amount that you have to take out at age 73, so that's gone up now. So let's say I have $1 million. I've been diligent enough. I've got $1 million in my RMD. And let's say I haven't had to draw on it yet because I've had other monies. Well, at age 73, I'm going to have to take probably about $50,000 out of that IRA. So I may have been going along, happy as a clam, living off of my wife and I's Social Security. Let's say we've done a good job. We have $60,000 of flow coming in from our Social Security, and that's enough for us to live on. And all of a sudden I have $50,000 drop into my lap. All of a sudden I went from a 22% bracket and probably only paying 85% on my Social Security, or maybe even less, and now all of a sudden my taxable income jumps to maybe 110 or 115. So, my taxable income went from 48 to maybe 115. That's a pretty dramatic impact or on my taxes. So maybe we want to look at doing a conversion. So, retire maybe a smidge early, convert some of that IRA to Roths. Roths are not required to have the RMDs. And so maybe that's a way to kind of help minimize some taxes. But unfortunately, the government here over the last 15, 20 years has really, if anything, they've kind of simplified at least kind of some of those tax calculations. They've taken away a lot of the deductions and other things. So most of us anymore are probably not itemizing and, so taking that standard deduction. And so unfortunately, there's not a lot of wiggle room there for much tax manipulation. So, so just some things here to kind of think about. You may want to consider some of those spousal strategies, especially if one's significantly higher than the other. Definitely consider those delayed credits. Run through those calculations and definitely work through that as a couple. We always, of course, highly recommend communication is key, right? So, work through those things together. So, it's also, an unfortunate thing of life, but probably at some point, one of those benefits is going to stop. So, you need to plan for and consider maybe possibly one of those benefits stopping at some point, and really what would that do to your standard of living and where you're at in life. So definitely plan on some of that. So with that, we kind of reached the end of our presentation here. You guys are welcome to unmute yourselves and ask some questions, and there's no as we say, there's no dumb question. So if there's something that you are wondering about, probably somebody else is as well. And so if we have any questions there, we're happy to field that. And as we had mentioned, you will get the slides tomorrow. Please fill out our survey. We'd love to hear from you on things that we can do or things you're interested in. Questions. And if you need to unmute, so if you press your space bar on your computer, I think that's one way to unmute yourself. So if you're not kind of familiar with that, I know the space bar is a way to unmute. So.
Hey, Dave.
Yes. Hey, Jim.
Hey, on the Social Security decision.
Yeah.
I assume that your situation when you're ready to retire and you need some sorts of income, I assume that depends greatly too on when you're strategizing there. Either if Social Security is going to be your only or your main source of income, or you have IRAs, 401ks, maybe a pension from your work, those types of things. And, so maybe taking Social Security early, you're taking a reduction, but you can keep your money in your 401k or IRA. I assume there's a lot to think about there, right?
Yeah. I mean, yes. I mean, sometimes you just got to do what you got to do. And not much you can do, but yeah, I mean, there's, and I used to always think, well, heaven forbid, I'm 62 years old, I get a death sentence, I'm going to pass away in 6 months from some horrible cancer or something like that, I'd be like, wow, I'm running out and collecting my Social Security. Well, if I'm the higher earning spouse, that means that, my decision that I just made to take mine early is going to affect my spouse for the rest of her life, as opposed to just maybe, waiting and letting mine accumulate. So, I think health definitely has something to play into that decision, other sources. you know, have something to play into that decision. And, you know, a lot of time, and I've kind of vacillated back and forth on when to collect it, in that, you know, if I run a retirement projection and collecting Social Security early, to some degree, it allows you to leave your other IRA monies or 401k monies alone, maybe for a period of time, and then start drawing on them later, you know, letting them compound. And I've normally found that you know, your retirement picture is better by collecting the Social Security a little bit early. So, but you know, that you listen to any of the, you know, as we've taken our classes and things, and listen to other folks, you know, they're all about the delayed credits and waiting. And so, you know, I think one of the things that we've kind of learned through the process is really how much those delayed credits mean on the back end. You know, maybe $12,000 to $14,000 more, you know, per year on the back end. So, but of course, you got to have longevity in order for that to come true. You know, so yeah, I mean, I think there's probably not a, you know, we'll never know what the exact right answer is going to be until the day we pass away, and you know, by then who really cares? But you know, but I definitely think, you know, kind of plan for a longevity, and then heaven forbid something happens and you pass away early, you kind of plan for, you know, to be around a long time, and then if something happens, you know, you kind of plan for that. You know, I don't want to say worst case scenario, but plan for that longevity. So, you know, I think another key thing is to never get out over your skis on your spending side. So, you know, if you can kind of control your spending along the way, you know, I think that's a big factor as well. You just don't want to get yourself in a bind to where you've kind of gotten used to a, you know, either a pretty high withdrawal thing, or, you know, what have you. Or so, you know, I think that comes into the equation too. So.
Thanks, Dave.
Mhm. Other questions?
Thank you all. This has been very informative.
Thank you, Dave. Other questions? So we are going to have, as we saw, we'll have a Medicare coming up here later on this year. So of course, key thing that usually comes along with your Social Security is applying for Medicare. And so, you know, even if you're going to take those delayed credits and maybe retire a little bit later, you know, you definitely want to make sure we're applying for Medicare, Part A at age 65. So we're going to cover Medicare in some pretty good detail later on. So with that, I think we'll go ahead and conclude here. And so, and if you think of something, by all means, you'll have Allie's email. You can find ours on the website. Call us, what have you. We'd love to help you kind of work through this decision. So, with that, we're going to go ahead and end our seminar. But thank you, folks, and hope you have a great evening.
Thanks, everybody.
Thank you.
Thanks. Good night.
Good night.